The third type of loan is FHA, which is my favorite type of loan for many different reasons. One is that, unfortunately, being honest and transparent, oftentimes you'll find that lenders will steer the buyer to an FHA mortgage, and the reason is the mortgage lender makes substantially more commission on an FHA transaction versus a conventional transaction. And so, for example, a lender on average in this market could make up to 5% on an FHA loan, where on a conventional loan they may only make 2%. And so if you have a customer that's on the borderline, what loan would you offer them, right? And so it's not ethical to do that, obviously, but it happens more than not. So if you have a client and you say to the loan officer, like, hey, what's my client's credit score? And they say to you, the client's credit score is 670. And you're like, okay, so is that why they're going FHA, or have you checked to see if they're eligible for conventional? Because short term, the FHA loan may be better for them, but long term, the conventional loan's gonna be better for them. So, and in this market, a seller obviously would rather have a conventional offer versus a FHA offer, so you're gonna run into that too. But FHA is an amazing loan, and often they're more challenging, which is why they get paid, you get paid more money, you get paid for your work, obviously, right? And so servicers, or the secondary market, which is who pays us as loan officers when you're a direct lender, will pay more for FHA because oftentimes the loans are more labor intensive. And so you can do an FHA loan with a 500 credit score. True story. 500, right? With a 500 credit score, you only need 10% down. The seller can pay all of your closing costs. You do not have to have a verifiable rent history. If you rent, you need to provide a verifiable rent history. But if you live at home and you have a 500 credit score because maybe you just haven't established your credit yet, that's totally fine. So there's no requirements other than you cannot have any installment lates. So if you have like car payments, student loans, fixed loans, like anything that's an installment loan versus a credit card, which would be considered a revolving loan, you can have any lates on credit scores under 580 with a FHA loan. That's kind of like a credit requirement, right? But most of the time, when you have a credit score under 580 FHA, I'm finding that that customer has gone through like a hardship, something like a divorce or a bankruptcy, or they just don't have credit yet because they're usually younger and they haven't had like a longer time span on their credit report, and so their credit score is lower. But the cool part about FHA, and this is the coolest part about it all, is that when it comes to interest rates with FHA, they don't change. And so what I mean by that is, obviously it's a fixed interest rate over the life of the loan, but with FHA, it's kind of like you're approved or you're not. So if you're approved, your rate is this, and if you're not, then obviously you can't buy a house, right? But with conventional, interest rates are based on credit score, property type, area, all different types of variations. And so you can see why if you have a 670 credit score, that loan officer may say to that customer, hey, the FHA loan is better, because when you add in all the adjustments to the rate on conventional, most likely with a lower end credit score, the rate is going to be substantially higher on a conventional loan, right? And so, but not every lender goes down to a 500 credit score. This is a huge niche for us. We're one of, I would say, one out of every 15 banks will go down to a 500 credit score. So that's a huge niche for us. I still okay? Keep going? You're good. Okay. So 580 credit score is kind of like where the next gap breaks off, FHA. At 580, you could do 3.5% down, which is the normal required down payment for FHA. For FHA, the 3.5% down payment can come from the client's own funds or can come from a gift from a relative. And so they can get a gift for the entire amount if they want to. But the minimum down payment is 3.5%. And another great thing about FHA is, as of March 2023, which is obviously where we are right now, the mortgage insurance was reduced by almost half. And so it was, 0.8 or 0.85, depending on what type of loan you were doing. And now it's, 30 to 35 basis points less than that. So it's a big reduction. So on I would say a $300,000 loan, like using that as an example again, it's about $115 savings on their mortgage insurance in March of 2023 versus February of 2023. So again, FHA loans are like really beneficial to the borrowers or to the clients when their credit scores are sub 700. So you'll probably see a lot of FHA loans. Additionally, the FHA loans, the seller can give a seller assist for all of the closing costs. And you can finance in the mortgage insurance upfront on that as well, similar to VA. So your FHA loans have two types of mortgage insurances. We'll get into a little bit of the negative now, right? So the mortgage insurances with FHA, there's an upfront mortgage insurance that's financed into the loan, and then there's a monthly mortgage insurance. The upfront mortgage insurance, again, is financed in over 30 years, so their loan amount's going to look weird. So if they're borrowing, $300,000 and they're putting 3.5% down, let's just hypothetically say that loan amount would be, let's say, $285, right? I'm doing the math off the top of my head. But their loan amount might look at like $297, $300 or something like that, because the upfront mortgage insurance is financed into the loan, so their loan amount's not going to be the sales price minus the 3.5% evenly. And that's a common question for clients often, because they look at their disclosures and they don't understand like why their loan amount is off. You know what I mean? The monthly mortgage insurance is included in their monthly payment. They will pay that monthly right now forever. So back in the day, I would say a couple years ago, on FHA, the mortgage insurance would fall off once they reached, their 20% or 22%, the way conventional works. But they changed it a few years back, and now the FHA mortgage insurance is on the loan for the life of the loan. So it's not really necessarily a long-term loan that I would personally recommend to a client if they had better credit. It's more of, I would say, a first-time homebuyer loan, which you do not have to be a first-time homebuyer for, by the way. But usually those are the kind of clients that fall into that type of loan, and then in a couple years we refinance them into a conventional loan. So that is a negative or a con versus conventional. The other thing is there's a ton of misconceptions about FHA. One of them would be that sellers often are like, I don't want to accept an offer from an FHA offer because the appraiser is going to ask for all these additional repairs. But in reality, there are no differences between an FHA appraisal or a conventional appraisal at all, other than scraping and painting. And so there is a lead-based paint disclosure that is associated with FHA. And so if the appraiser sees any like chip paint, for example, he's going to ask for those types of things, or safety and hazard issues. So often I tell clients or realtors, hey, when you're in the property, if you had your 2-year-old or your 3-year-old running around the house and there's something that looks unsafe to them, most likely the appraiser is going to call for that repair for your buyer. When it comes to appraisals on FHA, there's another positive with FHA, which is something called an escrow holdback, which in reality is like the coolest part of everything that I'm talking about. And so you guys all know that when you get an appraisal, the appraisal has to be as is. It can't be subject to. I don't know if you know what the difference of that is, but I can explain it to you after, obviously. But it has to be an as-is appraisal, meaning there are no repairs required on the property and it supports the sales price, right? Now, let's hypothetically assume that there's a big tree in the yard and the tree is ripping out, let's say, pavement or cement in the yard, causing a tripping hazard. So now you're like, hey, there's this big repair, and so the appraisal is going to come in subject to, and so in this case, they cannot close because the seller either needs to make the repair or the buyer needs to make the repair in order to close, because you need an as-is appraisal and you need a safe house to close on an FHA loan, right? But what we allow is something called an escrow holdback, which means we will allow you to close on a subject to appraisal, making the repairs after closing which again, many lenders will not allow you to do. They don't have that program. And so what that would look like is you would get 2 estimates from the contractors, 2 different licensed contractors, and let's say one says the quote is, $10,000, the other one's $12,000 or whatever, right? We would use the higher of the 2. We would escrow 1.5 times the amount of whatever that estimate is. We would hold that in an escrow. We would require that the repairs are done within 30 days of closing. So you're closing on a subject to appraisal. The repairs are being done after closing. This is not a renovation loan. This is a regular FHA loan. We hold the funds in escrow, which can be deposited by the seller or the buyer. Doesn't matter who. And then once it closes, everybody gets paid. Lender gets paid, agents get paid, borrowers get their keys, they get their house, they get to move in and everything, but they have to address that repair within 30 days. The appraiser will come back and do a final inspection once that's done, and then we will release any additional funds back to them that were held in escrow. Additionally, the interest rate also has to be extended 30 days past closing through that escrow held period of time.